Hello and welcome to the latest Insider interview. Our guest today is Alec Cutler, manager of the Orbis Global Balanced Fund. Alec, thank you very much for coming into our studio.
Thanks for having me.
Many people at home may not be familiar with Orbis, so can you give a quick overview of the funds that the group manages and what the investment style is?
Sure. In the UK, we offer three funds: a global equity fund, which would be kind of a higher risk fund, a global balanced fund, and a global cautious fund, which would be moderate risk in global balanced and a lower risk in global cautious.
And what is the investment style then?
We're contrarian investors, value investors, so we're tend to try and buy stocks or bonds that people don't want. We would look at a universe of things that have fallen out of favor, and then we would filter through and find the kind of nuggets that of companies and other securities that are worth a lot more than we can buy them for.
So you're running a contrarian investment approach. What does that mean to you, and where are you finding opportunities today?
Currently, we're underweight equities. Typically, for a balanced fund per se, you'd have about 60% in equities. We have a bit less than that. So fixed income is becoming more interesting to us as interest rates go up and yields go up. And we still have a significant position in gold.
So underweight equities, can you explain why you see them as a risky bet at the moment?
They're not risky. Well, they're always risky, but right now they're just a bit more expensive than they used to be. And bonds and commodities are relatively attractive. So we just go where we take what the market gives us, and the portfolio concentrations wind up from that.
What is the investment case for gold? It's gone up a lot in value, but why do you still back it?
Yeah, so we didn't own gold until 2019 when we started worrying about debt levels and deficit levels in the United States and developed world, where governments are just spending way too much money. And that puts the currencies of those countries at risk. So gold, if you will, is a 9,000-year-old currency that's never been devalued. It's never gone broke. So it is the most attractive currency over the very, very long term. And the dollar's just got quite expensive. Be a quick answer.
And how do you access gold in the fund then? Are you doing it via an ETF or gold miners?
We use ETFs and gold miners and royalty streamers, which we don't own currently. We've been shifting from the gold to the gold miners as the gold miners have fallen behind. As gold has risen, the gold miners haven't kept up. So we've been shifting from gold to gold miners.
And just how high could gold go? It's been on a very strong run. People might be thinking about maybe taking some profits. What's your position there?
Gold can just go higher. If the dollar devalues, then gold goes higher. So if fiat currencies or paper currencies go down, then gold goes up. We think that paper currencies will go down relative to gold because, again, governments are just spending too much money. Deficits are too high. The debt levels are going up and up and up. That makes those paper currencies worth less against what? Against all material items, gold being the best representation of a material item. So gold can and will go up over time, and we think it still has a decent place in the portfolio. We have been trimming it in favor of inflation-protected bonds, but still a significant position in the portfolio.
Fixed income in a world of rising government debts is generally negative, as well as higher inflation. So what types of bonds are you finding value in today?
So so buying a U.S. Treasury, for instance, you're buying to try and park money somewhere and get a return on it. But that return has to be higher than inflation. Otherwise, you're falling behind. So we look at a 10-year U.S. Treasury yielding 4.5%. We think inflation is going to be 4.5%. So you're actually earning nothing. You're just treading water. Whereas a 10-year inflation-protected bond yields 2% real. So you get 2% plus inflation. Twice a year, you get inflation plus your real interest rate. So if inflation winds up being 4.5%, and we have 2% real on top, we're getting a 6.5% return risk-free.
Do you take any measures to hedge the duration risk of owning inflation-protected security?
No, we just modulate the duration that we own. So we own a ladder of Treasury inflation-protected bonds out to, say, 20, 25 years. And the average duration of that is about 6.5 years.
On the equity side, you're underweight, but where are you finding the best opportunities?
55% of the fund is invested in equities. That's net. So we do use some hedging. There are certain equities that seem higher risk or are higher risk, higher beta, if you will. So we'll use market hedging to reduce the risk of those securities. So a high risk security example would be Micron, a semiconductor company in the US. It goes up and down a lot when the market goes up and down a lot. So we'll hedge out the market risk and lower the volatility of that. We're underweight because equities are expensive. So equities are becoming less attractive relative to fixed income or commodities. So that's where we go.
What are the best undervalued markets today?
We're finding value all around the world, except the U.S. in general. There are some securities in the U.S. that are interesting. Some stocks that are interesting. Things like that aren't household names. It's not the Nvidias of the world that were invested in the U.S. It's more like the Kinder Morgans. So rather than owning a very expensive AI stock, we'll own the company that owns 40% of the natural gas infrastructure in the U.S., just moving natural gas around and taking a toll. A very simple, mundane business that's really attractive from a cash flow standpoint, and we don't have to pay a lot for. And then the rest of the world, we've been heavily invested in defense contractors for the last 5-6 years. Energy infrastructure, in particular critical energy infrastructure, so the companies that make the natural gas turbines that are needed to produce the electricity to feed the AI factories to make AI. Rather than own AI, we own the companies that make the electricity for them.
On that defense theme, these shares have done amazingly well over the past 2-3 years. You don't like expensive shares, so are some of these companies now expensive, or is there still value in there? And which companies do you like?
Some of the defense contractors that we continue to own today, we bought 4 or 5 years ago, and they are up 10 to 12-fold. That said, if Europe is going to spend 3.5% of gross domestic product on defense, they're still cheap. Even though they're up 10, 12-fold, we bought them when they were extremely inexpensive, as contrarians will do. They've been successful investments, but that doesn't mean they need to be sold. If Rheinmetall, which we own, if Europe spends 3.5-4% of gross domestic product on defense, Rheinmetall is still a cheap stock. It's still a low valuation stock. If instead Europe reverts to spend less than 2% on GDP, say peace breaks out around the world and you don't need to spend, then it's a quite expensive stock. So at this point, a Rheinmetall is more a bet on continued growth in defense spending than it is about Rheinmetall itself and what they make and whether the products are successful in the market or not. All that's proven at this point, which was not proven when we bought it to begin with. So we own Rheinmetall, we own Saab, we own Leonardo in Europe. We own Hindustan in India, the biggest defense contractor in India. Hanwha, the biggest defense contractor in Korea, and Mitsubishi Heavy, the biggest defense contractor in Japan. As the global, the Cold War continues to spread out from Europe and the Ukraine to Asia, where it's actually more likely to be active in the next 5-10 years.
Artificial intelligence is a big theme at the moment, but you avoid that generally. So what is your take on AI? Are we in a new stock market bubble?
Possibly. These companies were expensive and rightly so to some degree. I mean, they've been very successful companies. So if you think about the core of AI, you're thinking about Meta, Google, Apple, arguably, Microsoft. And then right outside the ring there of those core hyperscalers, if you will, is NVIDIA, providing the infrastructure to make AI happen. We're not invested in any of those. They're quite expensive. And they are also challenged. So that core AI group is investing like crazy, in part because it's an existential risk to them. So all of those companies have a golden goose, if you will, like search for Google.
Yeah.
That's been a monopoly for them for years. And it makes all their cash flow, which they use to invest in all their other businesses like YouTube and Waymo, that search engine's at risk because of AI. Similar for the other companies, whether it's social media or online retail, AI puts those businesses at risk. So they have to spend a lot. So there's as much upside as there is risk. And the multiples are quite high. So we don't like the risk reward there. NVIDIA is just quite expensive. It's a very successful company. It will continue to be a successful company. It's interesting, though, that, and many people don't know this, NVIDIA doesn't make anything. They're kind of a virtual company. Taiwan Semiconductor makes their chips. And surrounding those chips are memory chips that enable the NVIDIA chip to work properly. The memory chips are the input-output, flowing stuff in and out, the data in and out. We own those companies. We own Taiwan Semiconductor, we own Samsung, and we own Micron.
Are there any other markets that are very overvalued today?
There are plenty that look expensive. We don't spend much time on them. We are, as contrarian investors, we wait until things fall into our lap, and then we'll look at them. So when we talk about areas that are super expensive, unless it's AI and very topical, we don't tend to know a lot about them. Luxury, European luxury stocks have been expensive for a long time. We'll get to know them when they fall off the bridge, and we can take them and look at them. But there's really no need to study them until they become cheap.
Alec, thanks very much for coming into our studio.
Thank you.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.